Thank you everyone for joining us today. Just a quick couple of notes before. All views expressed in this call are provided for informational purposes only and do not constitute investment advice. We urge you to please consult an investment professional before making any investment decisions to ensure that they will fit within your risk tolerance and investment suitability. For those of you joining us and the number of you on replay, thank you for sharing your time with us and joining us for our Back to School, Back to Basics video series. My name is Jeff Hunter and I'm Portfolio Manager with the Townshend, Somani and Hunter Group at Canaccord Genuity. Also on the line is our lead investment advisors, Dave Townshend and Rahim Somani. For more information about the team, please check out mywealthmanager.ca. Today's call is with one of Canada's top financial analysts, Canaccord own Scott Chan, to discuss things and everything related to Canadian financials. Scott's number of awards, including this year's Refinitiv Starmine Award for top overall earnings estimator for insurance companies. Before we get started, a couple of householding items. We have muted participants, but in the chat below, please feel free to direct any questions to Dave, Rahim, or myself, and we'd be happy to ask on your behalf. Today's call will be recorded, so make sure to check your emails in the coming days for the replay information, or follow our team's Facebook page at facebook.com/mywealthmanager.ca. With that said, let's get started. Scott, can you just provide a quick background on your career and what led you to where you are today?
Yeah, sure. I guess going way back, I think I really got into the stock market through my dad and family. So at a very young age, I knew I wanted to work in finance. I went to the University of Western Ontario, took business, and then started my career right after. And early in my career, I did do my MBA and CFA at Concordia University, which is the Goodman Institute. That was run by Ned Goodman. To really help kind of propel my career and accelerate it at an early age. So I started outside of Western. I started at CI Financial, which a lot of you are probably aware of. I worked there in 5 years in many capacities. I think I was, the rover person there. Anytime they needed a quick fix or help in a department, they would move me over there. So I got really, really good experience working for a very, very large asset manager at the time. And back in 2000, that's when mutual funds in Canada really started to take off. So it was extremely busy during that time period. After CI, I got the opportunity to work for a buy-side firm called Acuity. Some of you might be aware of Acuity, but we focused on small caps. We rode the income trust wave. I worked there for about 5 years as well, and eventually got taken out by AGF. Post-credit crisis. And then after that time period, I worked at a small sell-side boutique called M Partners for about a year, and the Canaccord position came up for financial analysts, and I've been at Canaccord for over 10 years now, covering financials, kind of spanning banks, life goes, asset managers, private equity, and some specialty lenders as well. So that's just kind of a brief recap of kind of my educational background and my work background, which is really centered around 3 places throughout my career thus far.
That's a great review, Scott, and thank you. And I think the important aspect here is clients and our friends and colleagues on the call, they get a better appreciation of not necessarily reading what's in the paper, but actually hearing from somebody who is studying these companies on a day-to-day basis, understanding their trajectory, their past, their history, the management teams. And it's not necessarily just a gut call on what they see macro-wise. So in leading with that, coming out of the pandemic right now, which who knows whether we're going back in one or not, that's conjecture, which we can't always answer. How have the banks fared, in your opinion, coming out of the pandemic? And how does it look going forward on one of 2 verticals? One, we continue to go in a moderate lockdown scenario, or vaccine comes on board and there are elements and opportunities or potential headwinds ahead.
Yeah, that's a great question. I think if I look at the Canadian banks or banks overall right now, your question about with the pandemic, the second wave coming has really caused more investor fears, and kind of just going back to March and the first pandemic on what kind of precipitated after that. I think before the second wave, which has only been about 3 weeks, that the banks felt, the banks and shareholders felt pretty good about the environment. And if the US bank earnings last week, in terms of the mega banks, told you anything, is that even though they had substantial earnings beats, and that was mostly based on credit, market sensitive items like capital markets, the bank stocks in the US still underperformed. And we think we're going to see that playbook happen again here in Canada, where we saw last quarter, the banks surprised to the upside. Stocks lagged, and when they report at the end of November, December, I think you'll see some good earnings beats across the boards. But investors are looking more for the more near term outlook, because of the unknown, the uncertainty of the pandemic. It really creates a lot of questions, more for banks than any other sector, because the banks really do touch every facet of every sector that we deal with in Canada. And that doesn't even include the US market, where we have an election coming up. And we do have the Canadian banks in Canada have US exposure in varying degrees, TD and BMO being the highest. But that uncertainty with the election is also, creating some angst within the marketplace on financials. And so I think we'll get better visibility over the next month or so with the election and banking results. But I think people are still taking that cautious view, or that near-term cautious view, into that. I think your second question related to if there's a vaccine, that is going to be positive, and some of it is priced into the marketplace, but not for financials at all. So if we do get a vaccine at some point next year, we see a massive opportunity for financial stocks to outperform. Because keep in mind, if you kind of look at the year-to-date performance, and even last year, financial stocks have vastly underperformed. And current valuations, we haven't seen these low valuations. Basically, if you kind of date back to the global financial crisis. So the Canadian banks on average are just trading above book value, with a sector in normal times that trades at north of 1.5 times. So if we do get a vaccine and things go back to normal and the economy recovers, you'll start to see the financials or the profitability come back pretty quick to pre-pandemic levels. We're of the view that that's going to happen at some point, and that investors that have a medium-term perspective on the sector, we think right now is a good time to buy, because it has been pretty beaten it up. At the same time, you get a very attractive dividend yields. People ask about if they're going to cut dividends, and within the big six, they're certainly not. Even if you look at the U.S. banks that have more credit concerns, they're not going to cut their dividends, because this time around during this pandemic, the capital levels at these banks are at a lot higher levels than what we saw during the GFC cycle. And a lot of it has been due to regulatory reasons throughout the last decade, as banks are required to put aside more capital for kind of instances like this. And even if you look at the last 2 quarters on the US side, and what we're going to see on the Canadian side, is that you'll see capital levels that will be above pre-pandemic levels at the end of this year, providing additional cushion on that dividend, which I think is a very key component on why people should continue to own banks medium term.
Those are some great thoughts. And so 2 things which you alluded to, which I think is on the minds of a lot of investors who are owners of banks. And, a couple of things that have been mentioned. Canadian banks are pioneers in the market. They send a signal to the investment community. So one thing, dividends are safe. Bank of Nova Scotia sitting out there with a 6.5% dividend. And I like how you formed it or framed it. It's a long-term game now, but we're in a valley. This is the value-driven opportunity. Should investors look at that 6.5% dividend and be in a position now to start accumulating these types of positions? I think there's a lot of chatter. BMO this morning, a lot of potential analysts are suggesting that they should be moving into a position to be acquired by investors as part of a balanced portfolio. So So that's one aspect. And the second thing is you touched on cash reserves and the safety net. I don't know if investors understand what the safety net means and how much cash is allocated, but if you could touch on that, that would be great.
Yeah. So it's great that you mentioned Bank of Nova Scotia and BMO, because those are the two most beaten up stocks, and those are the two stocks that trade, around that book value level. You're kind of right to bring up Scotia because it's been very topical over the last month, especially since its yield almost hit 7%, which is kind of unheard of a big six bank. Prior to that, you would think of CIBC as always being that big six bank paying the highest dividend yield. And then you get a bigger bank like Scotia trading at that, trading it, at those levels and offering that yield. A lot of people that I talk to are slowly dipping into Bank of Nova Scotia, with that medium-term perspective. Keep in mind, Scotia does have more risk, versus other banks because of its international exposure, its emerging market exposure. Combined, it's about 30%. So you're really trading off, a higher dividend yield for a bit larger risk near term, especially with the COVID-19 pandemic. Because if you think about when it hit, these international or Pacific Alliance regions, it really happened 6 weeks after it hit North America. So looking at last quarter's results of Bank of Nova Scotia, they were vastly different than the other 5 banks that have more of a North American exposure. And you can probably expect the same thing this quarter. It's going to be pretty noisy for Scotia. But if you can kind of look past that and kind of look at that yield, kind of look at that normalized ROE that they've done over time. Because remember, in these emerging markets that they're in, the profitability is greater, because banking is really more underpenetrated in these emerging markets than it is in Canada and the U.S. So Bank of Nova Scotia has been probably one of the most topical names from my view, from a retail and institutional standpoint, and I think people are gradually looking to step in. In periods, and we're kind of comfortable owning that bank over the medium term.
Just when we're looking at today's world, where it's in a low rate environment and in a very low growth rate in terms of historical perspectives, do you see further consolidation in the financial sector? Do you see companies expanding further throughout the globe and getting into greater reach into those markets? I know our company, we've bought companies in Australia, in London, and expanded that way. Do you see that trend continuing, or what's your position on it?
Yeah, so we do see that trend continuing, but it's going to take several quarters before the banks feel comfortable on deploying excess capital into M&A. A lot of it's regulatory, based on OSFI. As you guys are probably aware, OSFI are not allowing banks or life cos to buy back stock or increase their dividends. So capital preservation during this pandemic is paramount for the regulator. So they wouldn't be going out right now and making a large acquisition, because it probably wouldn't get regulatory approval in this environment. Because remember, the regulators are providing a lot of forbearance, capital light suggestions for the banks to work through this pandemic. So the last thing they wanted to see is banks using that forbearance and going out and making acquisitions. That said, if we do get a vaccine, things normalize, banks' profitability improve, the banks will be in an even better position for consolidation, and not just in Canada, but not domestically. And we talk about Bank of Nova Scotia, their push to add scale in the Pacific Alliance countries. BMO and TD's push to add scale in the U.S. markets, and even to a certain extent, CIBC and Royal all have communicated that they want to add scale in U.S. markets. As looking in Canada, there's not as many opportunities as there once was, especially on the typical banking side. So it's going to happen, but it's not going to happen right now.
It's interesting comments you made, and I think for investors, it's about looking at the horizon and seeing what is likely ahead. One question that I get often in meeting with clients is which of the Canadian banks are most technology driven, the use of artificial intelligence, data mining. There is, a certain instance where banks right now are migrating. I won't say that they're high grading, but they're move allocation of capital to overhead, to more research and development to really drive through to the consumer, whether it's lending, wealth, trading. So which of the Canadian banks do you think is best positioned in a technologically driven world, considering that we are using Zoom right now to connect with the audience?
Yeah, so I'll give my take, and it's fair to say all the banks think that they've got the best digital technological capabilities, and they've all spent an abundant amount of cash or capital into technology, and that is kind of heightened during the pandemic as we're all working from home. We all got to get set up. But from an overall perspective, Royal Bank would be the leader in kind of technology and advancement with AI. And that's not surprising because they have the biggest scale, and they actually incubate a lot of this within Royal Bank, not only in Canada, but in the U.S. markets. They've got a Silicon Valley set up shop in San Fran where they're working on all these types of technologies. And kind of following Royal Bank really closely, they do press release some of these, new ventures that they've been working on, that they've been testing on the past, and they've been able to, put it onto the system and give access to their clients. Most recently, you talked about AI. Royal's been kind of a leader on AI with certain partnerships with global firms, and they just launched AI technology on their trading desks to help clients navigate through trades. As you know, trading is very kind of saturated and simplistic at some points, but AI is another layer of support. Kind of certainly, helps Royal kind of maintain that leading market share and really gain market share in a lot of areas. And I'm just kind of pointing out one on the capital market side. You can probably talk about wealth management and other areas as well that they're constantly innovating, they're constantly testing and bringing these technologies and giving them access to their clients.
And tiptoeing a little bit on technology, this morning, Google for the 100th time is involved in antitrust sort of scenario in the US, and European regulators are really on the behemoths in terms of cornering markets and not allowing competition. Some would say Canadian banks are in a collusional mindset protected by the government.
Mm-hmm.
And there's various groups who want open markets and open access. It drives competition and innovation. Do you see a scenario where antitrust would play involved in Canadian banks and could create an opportunity to break down some of these models because they do tend to have high fences for emerging entrants?
No, I don't think so. I think that's come up a lot. You're right. I think the Canadian government does protect, the Canadian banks. But if you look at a lot of the other sectors in Canada too, it's very similar. If you look at telcos, lifecos, transports, airlines. So I don't think that would come because it's kind of that Canadian model where you have, certain strong players in certain sectors. People always ask the question, can any of these big six banks merge with each other? And I think that's where the issue would come, where the regulators wouldn't allow it. Kind of having big six, and you've got the regional banks. There is a lot of foreign Schedule 1 banks out there, like HSBC, Desjardins. There's a big credit union. So there is competition. I think banks hold significant market share in products like mortgages. But if you look elsewhere, there are a lot of kind of leading competitors that have an in there and can make that can make a statement or gain market share that the banks are in. Life insurance is one example. Like the banks don't really do life insurance, but life cos typically focus on that. So I don't think anything in that regard will come to the Canadian marketplace.
Now, you mentioned mortgages and the loan and mortgage deferral program in Canada. And as we move through this, it's a topic that continues to come up. I don't know if I've ever seen where people who are less qualified for mortgages get better interest rates than those who are more qualified. That's pretty interesting, but it underpins and softens the cushion in the market for housing. Who's bearing the risk here? Is it the Canadian government through taking these mortgages on the balance sheets in a sense that they're insured? Is it the sector as a whole? I see credit becoming very, very competitive. The loan rate environment is fierce at times. Banks, you mentioned it, credit unions, you got independent credit groups. So there are levels of protection in place. Maybe thoughts on that, and who's most exposed?
Yeah, that's a good question. I guess from a credit risk perspective, you're right. It is shared between, say like a Genworth on uninsured products, and then loans that are originated as uninsured, the banks bear the risk. So typically it's about 50-50. Housing is always very topical in Canada, but if you kind of look at the last 50 years on actual losses, they've been like a basis point or two. It's been immaterial. And that's why the credit environment in Canada is so much better in the US, because the way the mortgages are structured, with government support on half of it. And two, the housing market in Canada during this pandemic is the only thing that's been rising. So you look at these loan to value ratios and you think, the uninsured part of the mortgages that the bank have risk to, they're a lot more comfortable now than they were pre-pandemic, because the loan to values on these, have gone down. I would think that, looking at it last quarter, the loan to values would be pushing around 60% on average on these uninsured books. So you would have to see markets decline by over 40% before the banks would record an actual loss on these, right? And that kind of speaks to the loss rate that we've seen over the last 40, 50 years. Granted, we'll get periods in certain markets where, we could see a housing correction of 30, 40%, which would impact the banks because different borrowers, make up that LTV. But remember, the banks have the houses as collateral. They're not in the business of foreclosing and selling. They're, even going back to your deferral question, even though clients can't pay right now, but if they're a client at the bank for 15, 20, 30 years, they're going to work with that client to make sure that they keep their home and not take it away from them. So, the deferral analysis, and we'll get more of it in fiscal year end, but just talking to the banks intra-quarter, the banks have done a lot of data analytics on each client, how much they have in their savings account, how much they have in their investments. So they've got a pretty good picture on, the ability to pay on these mortgages, and then the mortgages that have expired, the payment continuation has been very, very high, in the high 90%. So I don't think credit is as big of an issue as people think in Canada, because a lot of people are saving money during this pandemic at the same time as well, plus getting government grants. The real issue is that if it stays on for longer, or we don't get more fiscal stimulus, that things get worse. But the way we sit right now, I don't think credit is as big of an issue as it's always played out to be in Canada.
Quick question. You obviously communicate a lot with these institutions and their executives, and you can turn on the news and see a number of negative headlines any day of the week. What are some of the positives and potential catalysts in the Canadian economy that they're seeing that might not be touched on all that often?
Yeah, that's a good question. You're right. The news always focuses on the negative. So I've avoided watching the news a lot, especially when pandemics or these waves have kind of heightened. But I kind of the biggest thing is kind of housing prices, mortgage growth. I think spending has come back month over month gradually that people aren't aware of as it pertains to banks. And if you look at capital markets, during times of distress and uncertainty, certainly looking at our firm, we're doing very well. The bank's capital markets are doing very, very well too, as clients need advice, they need capital, and there's potential for more transactional M&A type stuff next year. So the pipeline is strong on that. And even in wealth management and asset management, markets have kind of come back pretty fiercely. Net flows and confidence have come back from retail, high net worth, and institutional investors, and that really never gets some of the spotlight as well too. When you're talking about banks, and then kind of just going back to that capital and dividends. I mean, what you'll see this quarter is you'll see more sequential capital increases, more support of that dividend, and probably lower allowance builds, similar to what you saw on the U.S. side. As we stated, we think the Canadian marketplace is in a much better position than our U.S. counterparts.
A question today, Laurentian Bank hired a first female CEO in Canada. She started as a teller at Scotiabank, immigrant by nature out of Kuwait. ESG has become very topical. It's driving a number of mandates, I would suggest. We get a lot of referrals of new clients. There are questions that they're asking us. How do we incorporate ESG in our investment strategies? And we sort of reflect that we are financially planning for the future, but obviously the strategies that we like to employ incorporate these things. Your thoughts on first female CEO of a Canadian bank? Is this more to come? And secondly, the whole ESG and governance question, how much are you seeing it, and how much are you asking of it?
Yeah, those are great questions. I mean, kind of taking a step back, when I was at Acuity on the buy side, we were the pioneers of ESG investing. So about 15 years ago, we had the largest market share of ESG, where it was more of an institutional focus back then and not a retail focus. And if you kind of look at today, over the last few years, the retail focus has been increasing more. And all these companies, especially the large companies like Canadian banks and Lifecos, are providing a lot more ESG disclosures, ESG targets to meet. Because there is a strong correlation that companies that abide by ESG and hit targets typically perform better than companies that don't. So there certainly is a very heightened focus on ESG today. We're working on a lot of stuff internally. I see all the new funds openings in the U.S. and Canada, and investors want to put their money there as one, they feel better because they're invested in ESG type companies, and two, they typically outperform as well. So I think part of the investment process for a lot of the asset managers out there, and BlackRock would be kind of the pioneer on the U.S. side. You're seeing a lot more companies adopt it as it's becoming more retail mainstream versus institutional before. I used to cover Laurentian Bank, so I know the company very well and saw the news this morning, and I think that is something that is going to start going forward. You saw in the U.S. too, the first female CEO pretty recently as well. So as they kind of have these women targets in terms of senior positions and all these other targets, I think you'll start to see more of that to come in the Canadian marketplace and globally.
Just a quick note, if anyone has any questions, feel free in the chat on the bottom of the Zoom. just click it in there, type it, and more than happy to ask on your behalf. Just any quick thoughts on currency? I know not quite the biggest focus, but with these companies and their global footprint, do you see a lot of international flows coming into Canada and looking for these safer, on a traditional sense, banks to invest in? Or what's the outlook from the international view?
Yeah, I think from an international standpoint, that's what the Canadian banks have been trying to push for a long time, is to get a more diversified shareholder base. From my perspective, to be honest, and talking to our U.S. clientele, the typical question is, when do I short Canadian banks? Because there's always that view that the housing market is going to collapse as as one kind of primary indicator. And it always gets a lot of press when the U.S. or a big PM in the U.S. kind of talks about shorting the market, which over time has not worked. If you look at the big six performance or total return performance over the last 15 years, it has ranged between 10 and 15%. So you can do it on a short-term basis, like during the pandemic when the banks were down 30% plus very shortly. But over the medium term, or even like a 1 year period, it's typically not a good bet to short the company. So from a U.S. perspective, it's mostly from the short side, but there is value in owning Canadian banks, because if you look at the U.S. banks year to date, an average regional bank would be down 40%, and even looking at the mega banks, it'd be down 25 to 30%, where the Canadian banks have fared much better. So you do get that, you do get those conversations where people want to be long, but generally institutional people have a home bias or domestic bias within their home markets when they're investing.
Switching gears here a bit, but also tying into a client question, thoughts on a relatively flat interest rate curve, especially with respect to insurance companies. How are they going to prosper in a low rate world when so much of the capital has to be allocated for insurance or policy payouts? What are your thoughts there?
Yeah. So it looks like, that is one of the big headwinds on owning life insurance companies, for sure, because they have to match their long dated liabilities. And as you're well aware, interest rates, whether it's short term, medium term, or long term, are at historically low standards. And on top of that, it's pretty flattish, which impacts life cos and the banks, but it would impact life cos more specifically on that. A lot of it is priced into life co stocks. And if you look at the Canadian life cos right now, on average, they trade below book value. Manulife would trade at 0.7, 0.8. Industrial Alliance would trade at 0.8. We look at the U.S. life cos, who are more life insurance centric, so have a more exposure to life insurance and interest rates. A lot of these life insurance in the U.S. trade at like 0.3, 0.4, 0.5 times. So the market is pricing in this low interest rate environment in terms of generating profitability. And I think that's why, if you look in Canada, even with the excess capital, if you kind of go back the last 5-10 years, every acquisition has been outside of life insurance, because they have to diversify, their revenue and profitability streams. And I would point out to asset management and wealth management as two key areas of focus that add stability within fee income. And then, similarly to banks, what you'll see is that, when this pandemic normalizes, you'll see a big acquisition push from these life cos into asset managers and wealth managers, not only in Canada, but outside of Canada as well.
We get a lot of, referrals and for financial planning, and we do a lot of insurance sales for clients. We're seeing a huge surge amongst clients revisiting their insurance policies, having enough protection. I think what the one thing pandemic does do is refocuses not so much investors, but people on safety nets for themselves and their families. And looking at the whole insurance business, do you see premiums rising because the spreads are so low on the other side? And the second caveat to that question, I'm starting to see different types of insurance come to the market, pandemic insurance. Do these represent a earnings opportunity for these companies? I don't want to call them cash cows. Who knows if they'll ever pay out? Tornado insurance will rarely pay out, but most people will buy it in Alberta because we're a little bit more subjective to it. But do you see the new types of insurance providing growth opportunity? And where do you see premiums going near term?
Yeah, I can first start with the premiums question. The premiums are moving up near term, as you're well aware in most products. As life goes, reprice and reprice their shelf, typically once a year with with their product suite. As interest rates continue to grind lower, the premiums have to increase to kind of match that or to get that ROE they want on that product side. In terms of your second question on these new types of insurance, it's very too early to say because there's really no track record that you can look at long term because this pandemic is so fresh to evaluate if this is going to be a profitable product or not a profitable product. But I think in the good nature of typical insurance, I think it's necessary in this current environment. Makes people like myself a bit safer if I want to travel. In December, maybe that's a bit too early, but I think it's a bit too early to tell on the profitability as there's so much uncertainty regarding this pandemic, and frankly, we're learning every day on new data points that could affect it. But the insurers will surely readjust the pricing as they see fit on the experience that they do when they underwrite the product. So it's frankly way too early to tell to see if this is going to be a good profitability driver or not right now.
Just one related to elections coming up. There's a potential risk of a snap election in Canada as well. Do you see any risk or opportunities in the political horizon, just with what's going on in the US, positives or negatives for Canada, and even potentially in Canada as well?
Yeah. So I guess with the U.S. election, I think the most risk in Canada, in terms of like we're talking about my coverage universe, would be on the Canadian banks that have more U.S. exposure, and that would be BMO, well TD first, and then BMO. If the Republicans win or if Trump wins, it's typically more favorable for financials. Trump lowered tax rates, so corporate tax rates, you'll kind of see that stay. Remember, that was a big tailwind when he did lower it for BMO and TD 3 years ago. Trump's been very more favorable on, the capital market side, in terms of Frank Dodd, deregulation. That has been a boon to profitability for U.S. banks, specifically on the capital market side. So look in the Canadian banks, it would be Royal and BMO that would have the most exposure there. If Biden wins on the Democrat side, he's less favorable to financials. One, because he wants to increase the corporate tax rate. Two, he wants to eliminate a lot of that free fees on the banking side, like NSFs and stuff like that, which we get, but would certainly impact the top line and profitability on all the U.S. banks out there, and would have a little bit of an impact on the Canadian banking side. With TD, BMO, and in a certain respect, Royal and CIBC, you also have US P&C side as well.
In chatting with them, this is more client-related questions. I'll ask it in twofold to summarize. The one being, is Canada in a holding pattern right now? As we work through potential stimulus, low interest rates, earnings seem to be there. Unemployment is picked up, but it's not running away. A lot of structural support in place. Alberta seems to be in a very precarious position. It's navigating its growth cycle. because it's transitioning. So a couple things when speaking to your coverage universe, who are probably some of the titans in Canada, how do they view through a microscope or maybe even generally Canada right now? And are they a little bit more defensive, or, you know, as investors, sometimes we view the negativity as an opportunity. Are these guys and these banks with the amount of capital that they have at their disposal seeing this as an opportunity?
Yeah, that's
It's a
a good
loaded question.
yeah. I think holding pattern is a great reference to what we're seeing in Canada right now. I think the Canadian banks are holding in. Um, there's certainly a lot of risks out there, but I think the government and working with the government, in terms of fiscal stimulus, all these deferral programs that might have to be revisited, have provided immense support for the banks. Because certainly without that, the banks would have a lot tougher time right now. And I think that's the big question after these deferral programs roll off. What is it going to look like for profitability at the banks? And that's $1 million question, because it goes to all these economic indicators that are gradually improving, right? And we need to see that continually improve, and the main one being unemployment. That is the biggest driver of credit, and historically always has been the biggest driver of credit conditions. So if we can kind of gradually see that coming back and unemployment lowering, that is going to help the credit environment and the profitability at banks. I think from a growth perspective right now, there's really not much growth. There's kind of pockets of growth in terms of mortgages, and then certain personal items like credit cards improving from a very low level or a kind of muted level during the pandemic. Businesses are getting impacted a lot, especially small, medium-sized businesses. So you look at the commercial growth, it's really holding in or slightly declining short term to perhaps stabilizing and gradually improving next year. So I think that holding pattern analogy really kind of fits in what the banks are seeing right now. And I think if the opportunity presents itself, then the banks will get more aggressive on capital. But they're certainly a bit, taking a step back right now during the pandemic and kind of seeing how this all unfolds.
We have a lot of clients in Ontario. I'm from Toronto originally, and you're in Toronto right now. And we have a lot of clients in Vancouver, many dreaming of going there right now because we have snow in Calgary. Thoughts on the Toronto, Vancouver, Montreal housing market? Cottage country in Ontario is white hot. Do these trends continue? Can they continue?
Yeah, I'm a real estate junkie. My wife is more. We just sold our house in Toronto 2 months ago, and we're moving back to our condo downtown that we rented out in. And we've been trying to buy a place in the interim, but the housing market's very hot. And to be honest, my wife probably watches it on an hourly basis, and I do it on a daily basis and hear about it at home at night in terms of what's sold, what's up for sale, and whatnot. And my family's got a real estate company as well, so it's something that we follow pretty closely. My view it's going to be pretty strong to the end of the year. I think we had a lot of pent up demand from COVID when open houses and basically supply shut down. So you're seeing a result of that when things opened, that pent up demand. Secondly, which I think is going to be a tailwind for a while, you're seeing ultra low mortgage rates. And on top of that, you're seeing banks compete for that business, as typically it's like a loss leader for them because you want the client to get other products. So they're on pricing, they're very aggressive, and you can get like a 5-year fixed mortgage for like 1.7 or below 1.7%, which is kind of like that free money that makes it attractive to purchase at home. So I think you're going to get some instances next year where you'll have spots where there'll be opportunities to buy a place as the market softens. But if the economy does come back and immigration comes back, remember that was a big fuel for the overall Canadian housing market. That's going to support it medium term as well. So, from my perspective, we're hoping for an opportunity next year, and we think we'll get it. But I think generally you'll see the markets being pretty strong to the end of the year and into the start of next year as well too.
Perfect. Well, I appreciate your time. We don't want to take all of your day up. Thank you very much for your insights in these sectors, especially. We get a number of questions every day on the financials because they are so core to many people and their portfolios. Yeah, thanks again, Scott. And for everyone on the line, feel free to reach out to Dave, Raheem, or myself. We're more than happy to answer any further of your questions, touch base on what our views are and how to position yourselves accordingly. And with that, we'll just put it with the final disclosure screen and talk to everyone soon. Thanks everyone for their time.
Thanks, Patrick.